Corporate finance example problem using Excel. Financing, debt versus preferred stock. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left-hand side. We will populate that information into the blue area on the right-hand side, looking at a problem comparing debt versus the preferred stock for financing options. Keeping in mind as we go through this, financing, when thinking about financing, can be categorized into two major sections, that being debt versus equity. When we're thinking about debt, we have to add on the added complexity of the tax impact of it. So we have the debt, we're saying the can issue at yield to maturity of the 12%. So this is now giving us yield to maturity. We're thinking possibly bond here, but all we really need is the rate and not all the information on the bond, due to the fact that they gave us, in essence, the market rate, the yield to maturity rate, not the rate on the bond. That's the one that we can use with our normal kind of debt type of calculation to then take into consideration the impact of the tax. So note what we're not doing is actually adding or putting in place a dollar amount here. We're doing this just with the basic percents again, doing our comparison between the debt financing and the equity, in this case, the preferred stock. Tax rate then 35%. We have then the preferred stock down below with the price at the 75, the floating costs, the cost to issue the preferred stock, in other words, the 10, and the annual dividend, we're going to say, is the $6 on the dividend. Down here on the preferred stock side of things, we've got the dividends that we'll have to take into consideration, but we don't have that tax impact, so those are going to be some of the differences here. So then we're going to go to our calculation. So let's do our cost of debt after tax. We're going to say that the interest rate, let's say the interest rate is going to be then the 12% on it. That would be the normal cost, but we have to then take into consideration the tax impact so we can compare it to the equity, which doesn't have a tax impact, comparing, as they say, apples to the apples. Numbers group percentifying it, or same thing to the same thing. That's what it means, apples to apples. So 1 minus the tax rate, shift 0, colon, and this is going to be then 1, and then we'll pick up the tax rate, the rate of the tax, which is going to be equal to that 35%, making that a percent by going to the numbers group, percentifying it, going to the font group then, and underlining it. We could then make this 1 over here a percent as well. It might be useful. Now it's 100%, 1 minus the tax rate, 1 minus 0.35, or 100% minus 35%. Same thing. And then we can say the subtotal is going to then be equal to the 100% minus the 35%, making that a percent. Numbers group, percentifying it, and underline, font group, underline. That then, let's do some indentations here. Alignment, indent. And I'm going to indent this one again because that looks good that way. So cost of debt after tax is going to be equal to the 12 times the 65. Let's make that a percent. Numbers group, percent, add a couple decimals. So there we've got the 7.8%. Now we could think about this as just basically plugging in a number to see what the impact would be. And let's say we calculate this out and say, let's say interest, colon, and let's say that we have the debt, and let's just use the amount of the preferred stock price here for one preferred stock. So we can say, let's just use that for our comparison. If we had the debt for that, and then the interest rate is going to be for the debt this time, on the debt side of things, is that 12%. So then we could then say that the interest expense on average then is going to be equal to the 75 times the 12. Going to go ahead and add some decimals there. Number group, add a couple decimals. Going to select these 3 items and then go to the alignment, indent it, and then indent this one again. And then we're going to see the tax impact. If we had a tax impact, because we're looking at the debt side of things, tax benefit is going to, so then we're going to pick up the interest, which is now interest deduction, which would be that $9 because we get the benefit of the taxes on that. The tax rate times the tax rate, which I'll just pick up right here, is the 35%, you'll recall, because that's what we read on the left. Number group, percentify, and then font group and underline, and that's going to give us our tax benefit, which is misspelled up top, which normally doesn't bother me, but that's bothering me right now, so I'm going to change it. There we go, and then this is going to be then the 9 times the 35%. Let's add some decimals here by going to the number group, add a couple decimals, do some indentation, selecting these 3 cells, going to the alignment, indent, and then selecting this one, alignment, indent again. That looks nicer. Now we want to think about the cost of debt after taxes, which will be equal to the $9 minus the 3.15, adding some decimals there, numbers group, decimals, putting an underline under the 3.15. So there we have that. Now if we want, that's in terms of a dollar amount. Then if we add then the percent, what would the percent then be? Cost of debt after tax percent, colon, would be equal to the cost of debt in terms of a dollar basis, that 5.85. And let's add some decimals, numbers, decimalize. And we'll compare that to the debt itself. That's going to be equal to the 75, what we started with. And that'll give us the cost of debt after tax. And we'll say that that's going to be equal to the 5.85 divided by the 75, making that a percent. Numbers group, percentify, adding a couple decimals, underlining here, font group, and underline, so we get back to that 7.8, kind of verifying what we did over here on a percentage basis. Now let's think about the preferred stock. Going down to the preferred stock, what's happening in preferred stock world if we did this that way on equity side of things? Well, the price is going to be the 75. We're going to say that the floating cost, the cost to issue the preferred stock, in other words, 10, and the annual dividend, what we have to pay then on an annual basis, 6. So we're going to then take, okay, well, let's take the annual dividend here. We'll pick up the good old annual dividend, and this is going to be equal to 6. I'll put this in the outer column, and then I'm going to pick up what I'm going to call the net sales price, so net sales, colon, which is going to be the price, so sales price here at the 75 minus the floating costs, because we had to pay those in order to issue the stock. So that's going to be the $10 that it cost us to do that, which seems kind of high. And then we're going to say that's going to be the net sales, which will be equal to the 75 minus the 10. So we got the 65. Let's do some formatting here, selecting these 3 cells, alignment, indent, selecting this one, alignment, indent, looks way nicer that way. And then under the 10, we're going to go to the font group and then underline. And then we're going to finally get to the cost of preferred stock percent, which will be equal to the 6 divided by 65. Much more straightforward type of calculation here, not having to deal with taxes, you'll note. So we have the number, and let's go ahead and percentify that. That's going to be 9. Let's add a couple decimals because it's really 9.23 about. So the difference between the two, we have the difference between the options. Difference between the options is going to be equal to the 7.8 minus the 9.23. So it looks like the lesser amount of the cost of debt after tax would be the 7.8 on the debt side of things, the difference being the 1.46%. Going to put an underline here as well, font group, and then underline. Note that you can kind of think this through a little bit in more detail. If we think about the debt up top, the $75, we're saying to get the $75, it's going to cost us, we're saying on average yearly, the $9. That $9 is something that's going to continue for the life of whatever the debt is. In this case, if it was a bond or something like that, if it was a 30-year bond, we're thinking, for 30 years, we would have that, and then we'd have basically the cost of the bond, but it would end or mature at some point in time. Then we have the tax benefit, which once again is something that we would expect basically on average annually. Therefore, the cost we're seeing here at the 5.85 is basically the net cost kind of on an annual basis for the life of the bond to receive that 75. Down here, it's a little bit different down here. Note that we have the $75, but we're not really receiving the 75. We're subtracting out the flotation costs first, the cost of us to issue that, meaning when we first basically set this up, we're not actually getting the 75, we're getting the 65, because these costs are not annual costs. They're not things that are going to be repetitive. They're things that are going to be there for the issuance. If we wanted the 75, then I'd have to up this in some way to get it to 85 or something in order to account for the flotation cost. So that's one thing kind of keep in mind. And the other thing that to keep in mind here, of course, is the annual dividends are something that here are going to be basically annual. There's no end date. There's no set maturity date as well. So that's another thing to basically just understand when you're thinking about the comparisons between these items. But this will give you basically an idea, and the percentage will give you something, of course, that'll give you the comparability between the options.